If we look back at Bitcoin's 2017 bull run, the phases of the bubble we discussed earlier is very clear. Now, if we add some key moving averages to show us what momentum looked like, we see that the momentum of the bull market was extremely strong, especially during the mania phase of the bubble. All the key moving averages were pointing higher, and price stayed above them. When the peak was made, however, we see that momentum began to turn around. The moving averages curled downwards, and price struggled to stay above them. That shift marked the start of the painful blow-off phase. The reason this is so important is that every bubble is ultimately powered by the momentum of returns. During bubbles, most investors know that the behavior is irrational, but as long as the gains keep compounding faster than anywhere else, they keep participating. But when that momentum slows, it's precisely the moment where the market becomes vulnerable to reversing. Today, Bitcoin's price has broken below the key moving averages, suggesting that momentum might be weakening. But we also saw something similar in late 2023, mid-2024, and early 2025, where price briefly dipped below the moving averages, only to reclaim it and move higher. If Bitcoin is able to do something similar, we'll once again have a green light from momentum. But a rejection instead, with the moving averages sloping down, would make us readjust our stance quickly. For now, we have a setup where liquidity is abundant, demand remains strong, and price momentum has still not confirmed a breakdown. Together, these are the conditions that typically define the latter stages of the mania phase, not the beginning stages of the painful blow-off phase. In fact, we can see that long-term holders tend to usually sell into the mania phase, taking advantage of high liquidity and enthusiasm, rather than waiting for the bubble to burst. And that appears to be what's happening today as well. At some point, however, macro conditions will shift, and euphoria will reach extreme levels, eventually leading to this bubble finally bursting. And when it does, we think the fallout could be more severe than what we saw in Bitcoin's past cycles. After all, a large part of the current demand has been driven by treasury companies taking on increasing amounts of debt. Back in 2023, these companies collectively held around $2 billion in liabilities. Today, that number has surged to nearly $12 billion, with no signs of slowing down. And even Bitcoin miners have followed a similar path. Their total debt has skyrocketed from $2 billion in 2023 to more than $22 billion today. This growing leverage means that when liquidity eventually tightens, many of these highly indebted players could be forced to sell their holdings to meet their debt obligations, amplifying downside pressure and making the next correction more painful. But for now, we still believe this Bitcoin bubble has more room to grow, as far as price is able to reclaim the key moving averages, which is why we remain constructive on the asset.